So when we talk about owning precious metals, I don't tell people to do it to get wealthy. It is wealth. Wealth that has outlived every transition, 2 world wars, German hyperinflation, the Great Depression, every pandemic, and it will still be wealth when this situation ends too.
Andy Schectman explores the hidden dynamics driving the stock market, emphasizing the dominance of tech-based stocks and the potential risks associated with a slowing economy and credit crisis. Schectman introduces a mysterious shift away from treasuries towards precious metals, especially gold, as a compelling store of value. He delves into historical patterns, noting that countries exceeding 130% debt to GDP have historically faced default, suggesting a looming inevitability for the U.S. government. The alternative presented by Schectman is gold, foreseeing a significant surge in its value, particularly if OPEC and key nations abandon the petrodollar. As the conversation unfolds, he paints a picture of overvalued and undervalued areas, with precious metals poised to rise and treasuries undergoing a transformative shift in recognition. Schectman concludes by highlighting the enduring wealth-preserving nature of precious metals and the strategic moves by central banks, urging us to consider these insights in navigating the bumpy financial road ahead. With that, let's dive into the video to hear his thesis.
I mean, when you talk about momentum that has propelled the stock market, you have 7 stocks that, have kept the market afloat. And they're all tech-based. In fact, it's funny, the one shining star, NVIDIA, is a Taiwanese stock, I believe. So, you got these dynamics where the U.S. printed all this money, and much of it has flowed into the tech sector, in particular AI. But in an economy that is slowing the way that this one is, in an economy that is seeing the credit or a shortage of credit, a credit crisis, as far as I'm concerned, the liquidity being drained out of the system, that's a very dangerous place to be. I do believe he is right at that point. I do. But I also believe, as I said now twice, that we are on a shift away from treasuries into precious metals as a store of value, which could be a massive injection into that market. And let's not forget that, over the past 120 years, right? Anytime 100% of countries that cross over the 130% debt to GDP have defaulted on their debt. And it's usually due to massive inflation, hyperinflation, instead of outright default. But whether it be a inflationary default or an outright default, every single country over the last 120 years that has gotten to 130% of debt to GDP has never come back. That's where we are. The U.S. government really can't repay its debt, and default, in my mind, is inevitable. And as a result of that, holding U.S. treasuries would be as dumb as building a mud wall. So I think the alternative to the elite is gold, and it will soar. And I don't expect an explicit default unless, of course, Saudi Arabia and OPEC dump dollars as the store of value, or as the petrodollar, which I believe is highly likely ultimately. And then you have a villain to point to for your default. It was OPEC and Xi Jinping and Putin. How could they do it to us? But I think if I were going to make a trend, the only trend I would add to Michael's statement, which I believe both. I think AI is certainly overvalued and could very well transition out of there as the economy starts. Money would transition as the economy begins to slow. But by the same token, I would say precious metals go higher. I agree. But I would also say that we will move into a period of time where treasuries are no longer the go-to store of value. Anyways, bottom line is that, yeah, I think that he's right. He's spot on. I think that one area is massively overvalued, one area is massively undervalued, and one area, the treasuries, is going through a once in a generation shift of recognition. And I think it's going to be a very bumpy ride. So when we talk about owning precious metals, I don't tell people to do it to get wealthy. It is wealth. Wealth that has outlived every transition, 2 world wars, German hyperinflation, the Great Depression, every pandemic, and it will still be wealth when this situation ends too. And evidenced by the fact that the people who are writing the playbook, the central banks, well, they're loading up on it as if it was really important. So it's the suppression of the Western paper markets that has enabled them to do this without people catching on because the price hasn't exploded, and in particular in silver. So, yeah, I think what Michael is saying is 100% spot on, and he is someone everyone should check out. He's really a fantastic analyst. He has my great admiration and respect.
In this next discussion, Andy Schectman exposes a potential game-changing scenario in the precious metals market. He discusses the manipulation of silver prices by major banks, illustrating how a slight shift in the leveraged paper market can trigger a parabolic surge. Schectman hints at a strategy where these banks, with immense resources, could exploit arbitrage opportunities and strip the physical silver and gold supply clean. As he delves into the intricacies of market dynamics, Schectman emphasizes the critical moment when the leveraged paper prices on the COMEX reach a tipping point. He raises questions about the actions of major banks like JP Morgan, highlighting their fines and legal issues, but noting that the fines are dwarfed by their profits, leaving them in a powerful position within the market. Schectman concludes by asserting that the defining characteristic of the market will be not only significantly higher prices, but also the majority of available commodities being held on the other side of the globe, signaling a seismic shift in the dynamics of precious metals.
You can see how banks will arbitrage for a few cents a share, millions and millions and millions of dollars. Well, how about $100 an ounce? How about putting silver at $50 and watch what happens to all the silver over here that immediately arbitrages over there in a one-time shot to make these bankers very wealthy. And now we have stripped clean all of the physical silver and gold that would have been available for the people in this country who will wake up last minute and say, whoa, geez, I better get something. And it will define this market, the inability to source product on every level. And that's when the price goes parabolic. That is when the levered paper price on the COMEX, which currently is over 30 times leverage, where all it takes for a company like me to control 100 ounces of gold on COMEX is $7,000 in my margin account. Well, what if I have 500 million in my margin account like JP Morgan? Well, I can control 30 billion in gold futures. Do you think I can control the direction of the market or create a perception of reality? What if I'm told by the government, listen, we want you to do this. We want to, keep the bond market stable, keep the dollar stable. We need to accumulate some silver. We need it for all of these things, and we've sold most of our silver. So let's just go ahead, short the hell out of it. You're not going to get in trouble, even though it's illegal, even though it's concentrated, and we're telling you to do it, and violation of antitrust law or whatever it may be. Look, JP Morgan, when they paid this fine, well, what about JP Morgan? They got in trouble. Sure they did, right? They got 3 people in jail on very, very short jail sentences. They were brought up on RICO charges. No, they just got spoofing instead. They were fined $920 million. Well, that's the largest fine that the Treasury or that the Justice Department ever handed out at that time. Yes, it is, but their metals desk made $1 billion that year. They walk away up $80 million, and they're still allowed to be the custodian of the world's largest silver trust, amongst others, SLV. So when you talk about perhaps this is being kind of looked the other way by the authorities, allowing these banks to hold down the price of gold and silver because what it represents to a dollar and a bond market that are rehypothecated, that are showing the signs of fragility in the system, they've been able to do that for a long time. But the problem is when they started doing this, you didn't have half of the world with the wherewithal or the understanding or the demand to siphon all of these commodities at subsidized prices. Go ahead, suppress it. We're going to stand for delivery. So yes, it will ultimately be the defining characteristic of this market. Not only will it be much higher prices, it will be that the majority of what is available is on the other side of the globe, and it ain't ever coming back.
In today's discussion with Andy Schectman, we've explored crucial perspectives on the economy, the shift to precious metals, and the potential surge in gold prices. Schectman highlights the dangers of a credit crisis and the looming U.S. government default, suggesting gold as a promising investment. We've also delved into the manipulation of precious metals, prices by major banks, revealing potential consequences and the impending scarcity of physical silver and gold. Your thoughts on these insights are welcome in the comments below. If you found today's content valuable, remember to subscribe, like, and hit the notification bell for future discussions.